Denison Mines Corp is currently trading at $3.19, showing a strong intraday gain of 0.11 cents, which translates to a 3.57% increase. Many investors will look at this upward tick and immediately correlate it to the broader strength in the uranium sector, assuming it's simply a high beta play riding the wave of rising spot prices for yellowcake. The common expectation is that as uranium goes, so goes Denison. But the reality of today's move and the entire valuation premise for this company is far more intricate and tied to a critical company-specific achievement that the market is only now beginning to price in correctly. The true story isn't about the daily fluctuations of a commodity. It's about the systematic de-risking of what could become one of the world's most economically significant uranium mines, located in the safest possible jurisdiction. While everyone is watching the commodity, the smart participants are watching the drill cores and the hydrogeologic test results from the Athabasca Basin. It's easy to get caught up in the prevailing narrative. The bull case for uranium is straightforward and compelling. A global push for decarbonization is forcing a re-evaluation of nuclear power. Existing reactors are being granted life extensions, and a new fleet of small modular reactors is on the horizon. This is happening against a backdrop of constrained supply, with years of underinvestment following the Fukushima disaster and geopolitical tensions threatening exports from major producers like Russia and Kazakhstan. In this environment, a company like Denison, sitting on the high-grade Wheeler River project in Canada, seems like an obvious choice. The expectation is that a rising tide will lift all boats, and Denison is a well-positioned vessel. However, to stop the analysis there is to miss the entire point. The challenge to this simple thesis is that Denison is not a producer. It is a development stage company, and its success hinges entirely on its ability to execute a novel mining technique, in-situ recovery or ISR, in a geological setting where it has never been commercially proven. The company's value is not a reflection of today's uranium price, but a discounted probability of future low-cost production. Every successful technical milestone fundamentally alters that probability, and that is what is truly driving the stock. Looking at the recent trading activity, the volume accompanying this price surge is particularly telling. We aren't just seeing a low-volume drift upwards. The increased turnover suggests a re-evaluation is underway, with more institutional capital flowing in. This isn't just retail speculation on apps like the Robinhood app. These are larger, more calculated positions being built on platforms like interactive brokers, where professional traders execute. The stock has been building a base of support, and today's move is a breakout from a recent consolidation pattern. This technical strength is a direct reaction to the flow of positive news regarding the feasibility and environmental assessment of their flagship Phoenix deposit. Each press release detailing successful tests of the ISR process adds a layer of confidence and reduces the perceived risk, making the financial models used by analysts at firms that offer services like Fidelity Wealth Management look much more attractive. This isn't just momentum chasing like we might see in Tesla stock or Nvidia stock. It's a fundamental repricing event. The stock's performance is also decoupling slightly from its peers. While the entire sector is performing well, Denison's recent alpha can be traced back to its specific progress, suggesting investors are starting to differentiate between future producers with a clear path forward and more speculative exploration plays. Macroeconomic pressures, particularly the cost of capital, remain a headwind for any developer, but the exceptional projected economics of the Phoenix project, due to its incredibly high grade, provide a substantial buffer that many other would-be miners simply do not have. For those unfamiliar with the company, Denison Mines is a uranium exploration and development company focused on the Athabasca Basin region of northern Saskatoon, Canada. This region is often called the Saudi Arabia of uranium because it hosts the world's highest-grade uranium deposits. Denison's primary asset is its 95% effective ownership of the Wheeler River project, which contains two major deposits, Phoenix and Griffin. Phoenix is the real prize. It is slated to be an ISR operation and is one of the highest-grade undeveloped uranium deposits in the world. The company's business model is not to sell ounces today, but to advance Wheeler River through permitting, financing, and construction to become a major supplier of uranium in the latter part of this decade, just as a significant global supply deficit is projected to emerge. A crucial part of their portfolio is also a 22.5% ownership stake in the McClean Lake mill, one of the few operational uranium mills in North America. This gives them a strategic advantage, providing a potential pathway to process their future production. Many investors doing self-investing through an individual brokerage account with Fidelity or SoFi Invest are attracted to this combination of a world-class development asset and a stake in critical existing infrastructure. The choice of ISR for Phoenix is key. It involves pumping a solution underground to dissolve the uranium and then pumping it back to the surface, avoiding the need for massive open pits or underground tunnels. This method promises significantly lower capital and operating costs and a much smaller environmental footprint, which is critical for securing permits in the modern era. Looking ahead, the future for Denison is a story of milestones. The most significant catalyst on the horizon will be the final investment decision on the Phoenix project, which is contingent on securing all necessary permits and project financing. The market will be watching the environmental assessment like a hawk. Any delays here represent a risk, but a smooth approval process would be a massive green light. Another key factor is the long-term contract price for uranium. While spot prices get the headlines, utilities secure their long-term fuel needs through contracts signed years in advance. As this contract price continues to climb, it makes the economics of Phoenix even more robust and simplifies the process of securing offtake agreements and project financing. The risks are not insignificant. Execution risk is paramount. The successful application of ISR at this scale in the Basin is a major technical undertaking. Financial risk also looms. The upfront capital required will be substantial, and the cost of debt and potential for equity dilution are real concerns for shareholders. Furthermore, a sudden unexpected drop in the uranium price could change the sentiment around the entire sector. Comment below with your projection. Do you believe the uranium long-term contract price will clear $120 per pound before Denison begins production? In the opportunities column, however, the potential is immense. If Denison successfully brings Phoenix into production, it would be positioned as one of the lowest-cost uranium producers globally. This would allow it to be profitable even in lower price environments, providing a level of resilience that most competitors lack. Its location in Canada offers jurisdictional safety that simply cannot be replicated by miners in Africa or Central Asia, a factor that is becoming increasingly important for Western utilities. For investors looking for online investment opportunities with multi-year growth potential, Denison represents a calculated speculation on the future of energy. Whether using interactive brokers trading for sophisticated analysis or simply buying shares through SoFi stocks or the Fidelity mobile app, the core thesis remains the same. In conclusion, the movement we see in Denison's stock price today is far more than a simple reaction to commodity markets. The prevailing expectation is that it's just another uranium stock, rising and falling with the price of yellow cake. The reality is that this is a technology and development story unfolding in real time. The company's value is being forged not in the spot market, but in the geology of the Athabasca Basin and the ingenuity of its team. The market's perception is slowly catching up to the fact that Denison is not just hoping for higher uranium prices, it is actively creating value by proving out a world-class, low-cost mining operation. The tension between the simple commodity narrative and the complex reality of project execution is where the opportunity lies. And for now, reality is substantially exceeding expectations. Don't forget to like, comment, and share this video to support the channel. Hard-earned. Also, tag a new investor in the comments below to start their mining journey today. Oh yes, and for the dinner crew, let's chat where the Phoenix project models are looking for another round. Oh, and don't forget to use the disclaimer at the back of the video.